So you've spent decades saving and investing. The kids are grown, the mortgage is paid off, and now you're finally looking at your portfolio and asking the question, do I just live off my dividends or should I start selling some of my investments? And here's the thing, almost everyone I meet has the same gut reaction. Dividends feel safe. They feel natural, like a paycheck that you can count on. But there's a problem. That comfort that you feel might actually be costing you flexibility, control, and even more taxes over time. So, today, I want to unpack something that most retirees never really think about. And that's the real difference between living off of dividends and withdrawing from your portfolio, and which one might actually be better for your retirement income. And of course, we'll also talk about the emotional side because retirement planning isn't just about money, it's about how that money feels. So let's start with the obvious. There's something deeply satisfying about receiving dividend income. It's steady, it's automatic, and it feels like you're earning money without touching your savings. And for most retirees, it reminds them of their old working years, a regular deposit hitting the account every month. And psychologically, that feels good. It gives you the illusion of safety that as long as those dividends keep coming, that you'll never have to sell a single share and that your nest egg will stay intact forever. But here's where that comfort can really become a trap. Companies decide when to pay dividends, not you. And to maintain that income, many retirees start chasing high yield stocks or dividend ETFs, often without realizing that those higher yields usually come with higher risk or poor diversification. Now, I've seen plenty of times someone build a portfolio that's 80% Canadian banks and pipelines that are paying 5 or 6% dividends. Now, it looks good on paper until one of those companies starts to cut its dividend or the market shifts. And suddenly, that income for life isn't so steady anymore. So, yes, dividends feel safe, but feelings and facts don't always line up in retirement planning. Here's another thing to consider. When you live off dividends alone, the company decides when you get paid, how much, and whether they'll actually even keep paying it. When you live off withdrawals, you decide. You take control of when to sell, how much to take, and which account to draw from RSPs, TFSA, non registered. That flexibility is incredibly powerful when you start thinking about taxes. For example, you might choose to draw more from your RSP one year and less in the next, or sell certain investments to stay below the OAS clawback line. You can't do that if your entire plan depends on whether dividends happen to roll in. That's the hidden cost of set it and forget it investing. Now, let's talk about taxes, because this is where things get really interesting and where most Canadians are unknowingly giving money away. Now, dividends in Canada can be tax efficient, but only in certain situations. Now, if you're earning a dividend inside a non registered account, they're being grossed up by 38%. And then you receive a dividend tax credit. Now, this can work beautifully if you're in a lower tax bracket. But if you're drawing CPP, OAS, and other income, that gross up can actually push you into a higher tax bracket, or it can even trigger OAS clawback. So that tax efficient income suddenly becomes a tax headache. Now, on the other hand, when you withdraw money from an RSP or a RIF, it is 100% taxable as income. There's no credits and there's no discounts. And when you sell from a non registered account, only half of the capital gain is taxable. So the question isn't which is better, dividends or withdrawals. The real question is which mix gives you the most control over your after tax income. And that's what most people miss. You see, dividends are what I call incidental income. They're great when they happen, but you shouldn't design your entire plan around them. Now, withdrawals, planned, intentional withdrawals, give you something much more powerful, and that's control. Control over timing, tax brackets, and income flow. Now, let's talk about something few advisors really bring up, and that's the psychology of selling investments. Because let's be honest, selling feels wrong. You've been taught your entire life to save and invest, not to spend down. And when you sell investments, even as part of a smart strategy, it feels like you're losing money, like you're going backwards. But in reality, selling a few shares to generate income is no different than receiving a dividend. The only difference is who decides when the cash comes out. Now, a company can either give you a dividend by selling a bit of their earnings, or you can sell a few shares yourself. Now, the outcome, it's money in your pocket, and it's all the same. But here's the difference. With withdrawals, you stay in control. You choose when to sell. You can pick the most tax efficient place to take that money from. So instead of waiting for a company to hand you a check, you're designing your own income stream. Now, that's not reckless, that's smart. Now, let me give you an example. Imagine two retirees, both with $1 million in investments. Retiree A lives entirely off of dividends, earning 4% a year or $40,000. They never sell a single share. But retiree B uses a total return strategy. They invest in a diversified mix of stocks and bonds that grow around 5 or 6% per year. Now, each year, they sell $40,000 worth of investments to fund their retirement. Now, both get the same income, but retiree B has far more flexibility. They can choose which account to draw from, plan around taxes, and even reinvest when the market dips. Now, over time, retiree B often ends up with more wealth because their portfolio is built for growth, not just income. Now, retiree A, meanwhile, is stuck hoping that dividend yields don't fall and that the company keeps paying. Now, it's the difference between designing your income and depending on it. Now, I'm not saying dividends are bad. It's far from it. Dividends can be great components of your entire income plan. They add predictability that can help smooth out some of your cash flow. But the key word is component. A strong retirement income plan blends dividends with planned withdrawals, TFSA top ups, and smart tax management. So think of it like this. Your dividends are the foundation. They're steady, they're reliable, and your withdrawals are the steering wheel. They let you adjust the direction. Now, when you combine both, you get balance. You're not relying on the market to feed you, and you're not fearing withdrawals either. So, how do you actually make this work? Well, here's a general framework that I use when helping a lot of retirees design their own income plans. First, start with your non registered accounts. Use capital gains strategically. You're only taxed on half of the gain, and it often keeps you in a lower tax bracket. Then draw from RSPs or RIFs. So start earlier than 71 if it makes sense for you. Don't wait until minimums force your hand. Controlled withdrawals can save you from those big taxes later on. Also, keep topping up your TFSA. So use part of your withdrawals to fund or contribute to your TFSA each year. Now, this is going to create a tax-free pool of money for later on in retirement, and as well for your estate plan. Also, blend in dividends and distributions naturally. Don't chase yields. Let your diversified investments produce income as they normally would. The goal isn't to minimize taxes in a single year, it's to minimize them over your lifetime. And that's where math meets the emotion, because what people really want in retirement isn't just efficiency, it's peace of mind. Now, I often say this, a good retirement plan isn't just about income, it's about freedom. Freedom to travel when you want, freedom to help family when it matters, freedom to spend without guilt, knowing your plan supports it. And that's what a balanced dividend and withdrawal strategy is going to give you. It's going to provide a framework where you can live the way that you want without worrying about the next market swing or dividend payment. Now, I've had clients tell me that once they stopped focusing on living off of dividends and started thinking in terms of total return, they actually felt calmer. They realized that their portfolio could support them, not because it paid them income, but because it gave them control. So if you're trying to figure out which approach makes sense for you, here's how to start. First, list all your income sources: CPP, OAS, pensions, and dividends, and the potential withdrawals that come along with that. Know what's guaranteed and what's flexible. Understand your after tax needs. Don't plan for $60,000 a year, plan for $60,000 after tax. Also, run projections. Simulate how your income changes as your RSPs convert to RIFs and as you age. Also, avoid chasing yield. If an investment promises 8% dividends, ask yourself, what's the risk? Also, work with a planner who can integrate it all, because your investment strategy and your income strategy shouldn't live in separate worlds. They need to talk to each other. And at the end of the day, there's no one size fits all answer to the dividend versus withdrawal debate. Both can play an important role. The real power comes from knowing how to combine them in a way that gives you income, tax efficiency, and overall peace of mind. So, if you've been wondering whether your retirement income plan is optimized or if you're still relying purely on dividends because it feels safer, it might be time to look at the bigger picture. At Stone City Wealth, that's exactly what we do. We help Canadians create personalized retirement income strategies that blend tax smart planning, flexible withdrawals, and sustainable investing. Now, if you want to learn more, visit us at stonecitywealth.com. I'm Adam, and we'll see you in the next video.